Welcome to Line of Sight, Clearway Capital Solutions podcast series, where we talk to service providers, stakeholders and industry bodies that can assist fund managers and general partners in building their businesses in Australia and New Zealand. This podcast is for educational and illustrative purposes only and does not constitute and should not be relied upon as financial advice. The podcast will be provided to listeners on the basis that they are wholesale investors only within the meaning of the relevant sections of the Corporations Act.
Today we are joined by Paula McCabe, founder and director of PMC Legal, a financial services law firm with extensive experience in the financial services sector with a focus on managed funds. Paula and Dennis Mothoneos, managing director from Clearway Capital Solutions, discuss the key regulatory and service provider considerations for offshore fund managers and general partners who are considering providing financial services in the Australian wholesale and institutional funds management markets.
Today we have Paula McCabe from PMC Legal. Before we start, Paula, please briefly tell us a little bit about yourself and your firm.
Thanks, Dennis. Thanks very much for having me. So I'm the legal director and founder of PMC Legal, and we are a financial services legal practice. We are boutique in nature, but focus solely on funds management.
Paula, we often hear that Australia is a very attractive destination for offshore asset managers. And our understanding is this is really built on three pillars. The first one is scale. Australia has a relatively large pension pool compared to the rest of the region in proportion to its size of population. It's also generally considered to be quite mature. There are sophisticated wholesale investors that are prepared to back alternative or emerging strategies or generally new ideas. And it's also considered to be a fairly dynamic environment. The regulatory regime is evolving, but still considered to be quite welcome to foreign managers. ASIC also recognises several overseas regulators, which makes it easier and potentially faster for offshore managers to access investors in Australia compared to maybe other Asian hubs. And also the service provider ecosystem is considered to be quite strong. We have trustees, custodians, administrators, tax advisors, or most of them geared towards welcoming new investment managers and help them launch feeders, master funds, and other vehicles. First question to you, for an exploratory trip, does a manager need an AFSL?
That's a great question, Dennis. The general rule of thumb is that any person, whether it's an individual or a body corporate, needs an Australian financial services licence if they're carrying on a business in Australia. So if a foreign manager is contemplating an exploratory visit to Australia, generally speaking, we say they're not carrying on a financial services business. It's a one-off trip. There's not the requisite degree of system, continuity and repetition to constitute carrying on a financial services business. So normally they can get away without having an Australian financial services licence, but they need to be careful. So, simple things like genuinely making sure it is a one-off trip, making sure that they're not providing financial services to many people. So, if the intention is to come down, check out the Australian market, see who the service providers are, see who potential investors might be, then really information that should be shared should be factual information as opposed to any kind of financial product advice. So if foreign fund managers limit their activities to factual information and they're not giving financial advice to any person, and they're speaking to institutional or wholesale people in Australia, so the service providers, the large professional investors, then by and large, for that first off visit, they're not going to need a licence.
What changes for offshore managers if they conduct repeat visits or ongoing fundraising?
When a manager decides to return to Australia, on a repetitive basis, that's when that degree of system continuity and repetition kicks in. And so that's that subtle analysis of, is the foreign fund manager carrying on a financial services business in Australia? So there's no bright line test. We don't say, 2 visits, 3 visits, 6 visits, etc. Like that's the trigger point for when you're carrying on a business. So it can be a bit of a subtle analysis, but generally speaking, a couple of visits a year might be okay, but anything more than that, that's likely to trigger that requisite degree of repetition, and the need for an Australian financial services licence or the need for an exemption is triggered at that point.
We hear the terms comparable regulator and professional investor exemptions. Can you clarify?
Sure, happy to. The comparable regulator exemption is the key. If a foreign fund manager is regulated by a foreign regulator who ASIC, our Australian regulator, considers to be comparable to ASIC, then there are exemptions available for those foreign fund managers. So if I'm a foreign fund manager based in, say, the UK or the US, Singapore, Hong Kong, France, Luxembourg, there are a variety of jurisdictions. If I'm regulated by that foreign regulator and I comply with some conditions, I'm able to come down to Australia relying on my home jurisdiction's regulation to provide financial services to Australian wholesale clients. Now, the professional investor exemption that you are referring to, that was an exemption that was contemplated several months ago as a new exemption for foreign fund managers. With the change of government in April this year, the draft exemption lapsed. So there's no longer a concept of a professional investor exemption. So we're kind of back to relying on the existing comparable regulator exemption or other exemptions that might be available.
Are there restrictions on asset classes for offshore managers? For instance, if they're a hedge fund or a private equity manager or private credit?
Not really. There aren't asset class restrictions. So if you have a strategy that invests into private credit or hedge funds, private markets, pretty much most asset classes are acceptable. The only caveat is around digital assets. Our regulation in Australia around digital assets is perhaps not as mature as some other jurisdictions. So care should be taken if a foreign fund manager is looking to promote strategies that involve digital assets. But most other asset classes are permitted.
And how long does it take for an offshore manager to typically get authorised to engage with investors in Australia?
So if a foreign fund manager is looking to rely on the comparable regulator exemption, if I'm a new foreign fund manager coming down to Australia and I want to rely on the comparable regulator exemption, I now have to apply specifically to ASIC for relief for that. Once upon a time, there was sort of blanket relief that was provided to foreign fund managers regulated in particular jurisdictions. But we're in this sort of transitional phase at the moment, and a new fund manager has to actually apply to ASIC. It's a fairly simple process to make an application to ASIC. It usually takes maybe a couple of weeks to pull the documentation together, and it's a pretty self-explanatory pack that needs to be put together to ASIC. The application is lodged with ASIC. Their guidelines are they take about 30 days to review and consider the application, provided that there's nothing novel about the application. So if you're a foreign fund manager regulated in a jurisdiction that's already considered to be comparable, generally speaking, ASIC will review and approve the application within about 1 month. And then there's a little bit of toing and froing at the end of the process, whereby ASIC issues an acknowledgement to the foreign fund manager that they're entitled to rely on the relief. So it's a fairly quick process and not particularly burdensome. If I'm a foreign fund manager who's regulated by a novel jurisdiction or one which ASIC hasn't previously considered to be comparable to Australia before, then that can take a little bit of extra time, because you need to demonstrate to ASIC that that new jurisdiction is sufficiently equivalent to Australia, and those applications tend to take longer, say more like 2 to 3 months.
Also, Paula, we often hear about corporate authorised representative appointments, or the other option is to obtain an own AFSL. Do you have much to say about those options?
Both are valid options. We are increasingly seeing foreign fund managers rely on the corporate authorised representative exemption, which essentially means that they are appointed as a representative of another Australian financial services licensee, and you can piggyback off that licensee's license. You are technically acting on behalf of the licensee, so you can't kind of go off and do principal activities. You're representing the licensee, but it is something. It's an exemption that's quite widely used in the Australian marketplace and is very broadly accepted. For example, large superannuation funds will appoint foreign fund managers who rely on either the comparable regulator exemption or who are corporate authorised representatives of an Australian licensee. If the foreign fund manager is looking to manage an Australian fund, so potentially, set up a feeder fund, or it might be a fund that has a standalone investment strategy here, the trustees or the responsible entities of those funds may consider appointing the manager as a corporate authorised representative. The process is quite simple in terms. It's a simple agreement usually that's put in place between the licensee and the foreign fund manager, and subject to satisfying the licensee's due diligence process. These corporate authorised rep arrangements can be put in place in as little as 2 weeks. Maybe we generally recommend you have a slightly longer time frame in mind, because licensees want to conduct due diligence on the foreign fund manager and make sure that they're comfortable with the services that the foreign fund manager is going to provide, the strategies they're offering, the clients they're going to be speaking to, and work through some of the commercial terms of the arrangement with the foreign fund manager.
And an own AFSL?
Own AFSL. So that is definitely is an option. It takes a lot longer to get your own AFSL. So that's more like a 6 to 9 month process. It's a little bit difficult to predict how long ASIC might take to assess and process an Australian financial services licence application. And the timeframes can change depending on the volume of applications that ASIC has before it at any given point in time. But around 6 to 9 months is a sensible timeframe to have in mind. There are, I guess, some potential drawbacks of having your own AFSL, particularly if you're regulated in a foreign jurisdiction. There can be some duplication between the two regimes. But if you're in a comparable jurisdiction, then notwithstanding the duplication, generally speaking, we find what's required to be done in the foreign jurisdiction is similar to what would need to be done, in Australia as well. So there are many organisations that will look to comply with both sets of regulations if they need to.
Well, we often hear the words trustee and responsible entity, and they may be terms that offshore managers might be relatively unfamiliar with, or the meaning could be different in their own jurisdictions. In the Australian context, what do those terms mean?
A trustee and responsible entity are really trustees. They're different terms, really based around whether or not a product is going to be offered to wholesale investors only, or a product is going to be offered to retail investors. So trustee is the term that we use for an unregistered managed investment scheme, sometimes referred to as a collective investment scheme in other jurisdictions. Whereas a responsible entity is the term that the Corporations Act uses to refer to the trustee of a registered scheme, being a scheme that's capable of being offered to retail investors, so your mum and dad investors. They have very similar obligations in the sense that, both are trustees, so general trustee type duties apply to them. But the key difference is that a responsible entity of a registered scheme has more statutory obligations imposed on them. So they have slightly different licensing requirements, capital requirements, compliance requirements, and more onerous disclosure and general regulatory requirements imposed on them compared to a trustee.
Very often there are sort of two options for offshore managers, either setting up a direct onshore master fund or an Australian feeder. Both of them have their pros and cons. In our experience, a feeder is sometimes less costly to operate, lower custody and administration costs, and it allows you to leverage an offshore track record in some circumstances, and syncing the pricing liquidity with the master or the offshore master. The downside is disclosing aggregated master and feeder fees, and some tax rules can bite Australian investors. Whereas the master fund or the onshore master fund perhaps has cleaner fee transparency and is maybe preferred by some larger super funds, but the running costs, particularly for certain strategies like, say, emerging market equities, could be higher. Do you have anything to comment on that?
I 100% agree with your observations there. Both are very viable options, and there are pros and cons of both. I think it depends on what your investment strategy is, and it depends on what your cornerstone investors might prefer. But we definitely see a mix of both feeder funds being set up in Australia, as well as standalone trusts where the investment strategy is executed here in Australia. So I think when the product idea is clear, the foreign fund manager just needs to engage with the service providers here in Australia, engage with their prospective investors, and ascertain what's the best structure for that particular product.
Single class and multi-class funds, what would motivate them to set up multi-class funds, and how does that potentially influence their distribution strategy?
Multi-class funds are very common in the Australian marketplace. Typically, we see multi-classes for a couple of reasons. One is for differential fees. So you might have a a retail class, for example, which might have slightly higher fees because potentially the costs of distribution are higher. And then you might have a wholesale class where there's a discount effectively to the fees on offer. So differential fees is one reason why we see multi-classes. Another might be to do with hedging arrangements. The strategy might offer a hedged versus an unhedged currency hedging, obviously. I'm referring to arrangement. You can offer multi-classes that have different investment strategies per class, but they tend to be a bit more complicated, and the risk of cross-class liabilities is something that needs to be navigated and carefully thought through if that's something that's the viable option. The more classes you have, the tendency for the product to be a little bit more expensive to operate. So administrators will often charge slightly higher fees for multi-class funds, whereas a single class offering will typically be a little bit less expensive to administer.
We're hearing managers considering listing their products on the ASX more and more. What do you think about that? Any comments?
Definitely there is an increase in popularity of exchange-traded funds in Australia. We have a couple of different structures that are available to us. So we have a traditional listed investment trust, or a LIT, and that's where the fund is listed on the main board of, say, the ASX. That is a closed-ended, fixed pool of capital type structure, and typically suits more illiquid assets like real estate funds, although we're seeing a trend of private credit funds go on to the main board. There are some equity funds that are listed on the main board as well, but the challenge with some of these sorts of funds are they tend to, or they can trade at a discount to NAV, discount to net asset value. Other types of funds which are newer, but still it's a very mature market, are our quoted funds. So a fund can quote on a securities exchange, which might include ASX's AQUA or CBO, and those funds can either be passive or active. But the key is that those funds have to have transparent pricing. So investors can come in and out of these funds on a daily basis. They have they're not closed-ended, so they're open-ended. They provide liquidity and pricing. You trade in and out of these exchange-traded funds just like you do any other security on the exchange. You don't get the same discount to NAV problems with these sorts of quoted products, but not all products are suited to be quoted. So, for example, you can't have a capacity-constrained investment strategy and quote that on an exchange. It has to be open-ended, which means that it tends to lend itself to, global equity strategies or fixed income strategies or any kind of strategy that has deep liquidity and the capacity isn't constrained by the amount of money that's being invested by the fund manager.
Paula, any final sort of practical tips for offshore managers seeking to engage with Australia?
In terms of practical tips for foreign fund managers seeking to engage in the Australian market, I would say, firstly, seek some professional advice to make sure that you are not falling foul of the licensing and regulatory requirements. Of course, that's a very self-serving statement, but I think that's the first step. The second thing is to make sure that your marketing materials are carefully reviewed and thought through before you come down to Australia. So if it's your first exploratory visit, it's worth having your marketing collateral, your pitch deck reviewed to make sure that it doesn't contain financial product advice, that it looks more factual in nature. If it's not your first exploratory trip, if this is a repeat visit and perhaps you're already relying on an exemption like the comparable regulator exemption or a corporate authorised rep exemption, it's worthwhile getting your materials reviewed to make sure that you've got appropriate disclaimers to reflect what particular exemption it is that you're relying on. And then finally, track what exemption you're relying on. So if you are relying on the comparable regulator exemption, make sure that your exemption is up to date and there have been no changes to the relief that you're relying on. If you're relying on a corporate authorised representative exemption, make sure that the authorisations that you're relying on, so the products that you're allowed to promote, are covered by the terms of that corporate authorised rep arrangement.
Thanks for your time today, Paula. If you'd like our white paper, which covers these issues in more detail, please contact Clearway Capital Solutions. Or if you'd like specific legal advice, please contact PMC Legal.